Olga, you just came off stage having delivered a presentation on corporate strategy and value creation. And so I'd like to talk about a couple of points you made around sort of these inflection points that you've noted in the way that industry strategies, particularly the IOCs, have evolved. And so the first one of those was around, shareholder returns and reinvestment in the portfolio. And we've seen a pretty significant strategic shift there. So tell me a little bit more about that.
Yeah, so I was talking mainly about majors and like how they changed their priorities over the last 7 years. And the idea is that the massive shift happened in their capital allocation strategy and basically how they distribute their cash flow from operations. And this is driven by the pressure that they're getting from their shareholders, where they actually want them to prioritize share buybacks and dividends. So the inflection point that happened over the last 5 years is that their payout ratio, which is the combined dividends and share buybacks as the share of the total cash flow from operations, exceeded their investment ratio, which is like how much they reinvest back to support the growth in their upstream business, for example. And the thing is that in 2021, we saw this like inflection point where the payout ratio started to exceed the level of their reinvestments. And this is a structural change in how they approach this cash flow distribution. So that was the first thing. And then the second inflection point that we observed around the same time frame, but in 2 years later, was in 2023, where when we look at the spendings in their exploration versus the spendings in their low carbon business, we see how the low carbon spendings exceeded their exploration spending. And I think it's a very interesting trend because both things are kind of like venture capital and they explore the opportunities rather that is opportunities within upstream in the form of new discoveries or opportunities within clean tech or lithium mining or data centers. And that's where they explore how they can future-proof their business. So these are the things that have shifted and had, I think, like big impact on their portfolio performance.
But I mean, what does this mean for the resilience of their upstream portfolios in terms of if you're getting more back to shareholders, or if you're investing more in low carbon businesses than you are in exploration or back into your business, how does that impact the resilience?
Yeah, that's a good question. So the one of the main KPIs that we can look at to understand the magnitude of the shift is the resource replacement ratio.
Okay.
So this is something that companies were struggling to maintain over the last 12 years.
This is how much they're discovering, how much resource they're adding versus how much resource they're producing.
Exactly.
Okay.
Yeah. So basically, this resource replacement ratio was on a decline trajectory since 2011. And it went down from like 100% down to 50%. So they were struggling to replenish their resources and they were not like catching up with the pace of the production and versus the exploration, conventional exploration and additions from shale. So that's one of the things that really challenged their resiliency. And if we are to break it down into the specific companies, we can see that some of them, to improve the situation, they kind of went shopping and bought resources, acquired companies, acquired projects to stabilize their production level going forward. And some of them still managed to deliver good exploration results, and Eni stands out as the one that had 100%, 91% resource replacement ratio.
So, I mean, in terms of what investors are looking for and how companies have performed in terms of both the share price and total shareholder return, creating that value that we're talking about here. I mean, what can we discern from these trends in terms of what's working, what's resonating, and maybe what's not?
Yeah. So in my presentation, I was talking about the metric that I think is quite interesting to look at to understand the differences between these 7 players that we're talking about, which is TSR, total shareholder return. And when we look at the TSR, there's like obvious leaders and laggards in the group. And those that are in the middle, kind of like medium return group, right? And the thing is that I think the main misconception in the market right now is that those companies that invested into low carbon struggle to deliver competitive level of this total shareholder return. But the reality is that it's actually their underperformance in oil and gas that was the major contributing factor that didn't let them to unlock that level of TSR as companies like Chevron and ExxonMobil managed to deliver over the last 5 years. So it's much more about the longevity and resiliency and profitability of your oil and gas business that helps you to be profitable and investable in this new market reality. And it gives you more flexibility to explore different technologies and look into your venture capital with some new ideas where you can grow your business going forward outside of your core. But you have to make sure that your core is strong enough to support you venturing into something that is less competitive on the return side.
So if you get that core right, then you've got maybe more freedom to experiment in other areas. But if that core's not there, then not a lot you can do.
Yeah.
Well, excellent. Olga, thank you so much for joining us on the debrief. And I really look forward to speaking with you next year at the summit.
Thanks, Noah. It was my pleasure.